Does dollar cost averaging actually help boost your returns, or is it a detriment to returns? New study and perspective coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. You might not want to in this case if you're a fan of dollar cost averaging, though. A recent study came out and sort of back-tested historical returns with how should you invest a lump sum of cash. Do you invest it all at once, or do you do something called the dollar cost averaging approach where you spread it out and invest it over time? Well, the math suggests that it is better to invest that lump sum of cash all at once, okay? And depending on what you're investing in, that can be obviously the case, or it can just be a clearer, better strategy. But to me, there's more to it than that. Let's get into it. So dollar cost averaging, if you're not familiar with that geeky term, it's what you're doing when you contribute to your 401k. It is taking a certain amount of money and investing it automatically, consistently over time, okay? So every time you get paid, a little bit comes out of your paycheck and goes into your 401k, and you're using that amount of money to buy shares of investments, whether that's shares of mutual funds or whatever, okay? You're buying shares. Well, you're investing that fixed dollar amount. Say, for example, it's $1,000 a month. All right, that $1,000 a month is buying more shares when those share prices are low, and it's buying fewer shares when those share prices are high. Think of it like going to the grocery store. If you're going to buy $100 worth of groceries, you can buy more groceries when they're on sale. You can buy less groceries when they're expensive, and we've got inflation, okay? It's transitory. Don't worry about it. So that's how dollar cost averaging works. You're investing a little bit automatically over time, and what it means is the math suggests you're buying, on average, shares at a lower price than you would otherwise be doing because, again, you can buy more shares when the price is low, and you buy fewer shares when the price is high. It's a way of just automatically timing the market in a way that you're buying more low. Well, to me, that's a fantastic approach to investing, and it's a logical way to invest because most of us don't sit around with a pile of cash that we just say, well, what should we do with this? You know, most of us are automatically investing out of our income. But what if you have a chunk of cash? What if you received an inheritance? What if you received some sort of windfall? What if you received some surprise commission or stay bonus or something like that? What if you sold a business or something like that, and all of a sudden you find yourself with a chunk of dollars that it's meaningful to you, so it's not, you know, it's no small sum, so that's a relative term. How much is a lot? Well, you know, 50 grand to some, maybe $1 million to others, okay? So you've got a lump sum of cash that you work with your CFP and you look at all 6 areas of your financial life and you say, I mean, this money is long-term money. It should be invested in the markets. All right, so how do you get that money in the markets? You can invest it periodically over time, a dollar cost averaging approach, 12 months, 18 months, 24 months, where you take the lump sum that you have, divide it by 12, 18, or 24, however long you're going to drip it into the market, and automatically invest that amount over that period of time, where again, you're buying more shares when the price is low, buying fewer shares when the price is high. So that's one option on how to invest that lump sum. Or second, you can just say, all right, it's Tuesday. Seems like a good day. Let's just take this $1 million and invest it in the market. And typically that is not what's recommended, but what's the math say? The math obviously says, this is obvious. 75% of the time, it is better to invest the lump sum of cash automatically without doing dollar cost averaging, just taking that lump sum, throwing it in the market. 75% of the time, that's the better approach. That's what the research says. That's what history says. Why is that so obvious? This is a 100% stock portfolio. Why 3/4 of the time is it better for you to just not dollar cost average, just throw it all into the market? Because 3 out of 4 years are typically positive in the market, right? If the market on average is sloping upward, then likely on average the cheapest price you'll buy is here. And if this is, and sorry for the crude illustration here, but if the market is going up and down, but it's trending in this overall direction, again, you might not time it perfectly on the month, but buying it today is likely going to be at a cheaper price than what it will be what the market will be 24 months later. I mean, that's just obvious. That's why you invest. That is the reason why you invest. Yeah, 4 out of 5 years, the market's positive. 3 out of 4 years, the market's positive, something like that. On average, the market's positive, okay? So, of course, the math is going to suggest this. I don't know who was the brainiac that said, we should do this math. It unnecessary, okay? Nearly 100% of the time, by the way, if you're not a risk taker, you're not comfortable with investing in stocks and you'd rather invest in bonds, nearly 100% of the time, it's better. I do wonder about that data, though, because nearly 100% of the time since the last time we saw inflation, bonds have actually added some extra return, some capital appreciation, because interest rates have been dropping for 50 years. So to me, could we be in a different time period with bonds? I don't know. But if you're investing just in bonds, nearly all of the time, it's better for you to invest that lump sum all up front as opposed to dollar cost averaging. So it's that, if that's the math, and if that's so obvious, right? I'm not trying to shame anyone here, but you invest because on average the market goes up. Okay, so if you receive a windfall, a big contract, sell a business, something like that, mathematically the odds are in your favor that you should invest it all up front. Well, why wouldn't you do that? Why would I still recommend the dollar cost averaging approach, even if it's mathematically an inferior strategy? Well, let me ask you this. Every single year, do you refinance your mortgage and take all of the potential money out that you can and invest it? I mean, if we're talking about math and what history says, it's always been better to borrow money at this amount and invest it all in the market because you're going to earn this. It's always been better. I think there's 3 times over a 15-year time period where the stock market's been negative over 15 years. There's never been a time over 20 years. And certainly there's never been a time over 30 years where you've been worse off in the market. So you should never pay off your mortgage. You should get a loan on everything you possibly can. And then as the bank forces you to make payments every year, you should refinance to take out even more. Or the value of your property goes up, you should refinance, take out even more. You should leverage everything if it's just about the math. But it's not. It's also about risk, and it's about financial freedom, and it's about achieving other things financially, because the way I see it from a 6 areas of financial planning standpoint, at least with this mortgage example, debt is bondage, and that could mathematically lead to higher returns, but there's more risk and there you have fewer options, i.e. there's a global pandemic, you lose your job, now you don't have the income to afford that payment. What if the government doesn't, suspend mortgage payments and all that stuff that they did last time? What if you get disabled? What if whatever, right? You're taking risk with that. And to me, yes, the math might be better, it might be inferior, or it might be superior, but why take the risk where, okay, this either works or it doesn't, and I kind of crap out, if you will, because that feels like gambling. And so to me, dollar cost averaging, I would still consider it, especially right now, for a couple of reasons. Number one is your emotions and my emotions. If I have a windfall, something that's a large sum of money to me, and I invest it, and within 3 months, say I invest it in September of 2018, good time in the market, market had a fantastic 2016, 2017, everything looks good, and within 2.5 months, the market's down 20%. For really no reason other than the Fed started trying to, increase interest rates and do some things, stop printing as much money, and the market didn't like that. Nothing else really changed, but the Fed stopped supporting ththings and the market dropped almost 20% in a matter of a few weeks. And so if you took $1 million and threw it in at that time, 2 months later, would you stick with it? Do you remember Christmas Eve? You remember Christmas Eve of 2018? Do you? I do. I do. I'd worked in the morning and we were off the rest of the day, and the kids were young, and we were at Barnes & Noble kind of looking at books and whatever because the kids needed to do something. They were so excited about Christmas, and I was freaking out inside. Why? Because on a half day in the stock market, Christmas Eve, no one's working. Traders, there's really no activity. The stock market was down over 2%. It's the worst Christmas Eve ever. That is on top of a big waterfall drop that we had. It was scary. That was frightening. It was a very nerve-wracking time for investors. If you had invested in September, watched your investments drop 20%, would you have stuck with it? Or would you have emotionally said, I gotta make a change here. This is not working. I made a mistake. And could you be scarred for investing forever and never to return, or jump into some annuities or some other tool because, I've got to buy some guarantees, and then you end up making a huge mistake? Inherently, as humans, we're hardwired to have that natural instinct. Would you have that natural instinct? Maybe not. But on average, we would. And so mathematically, because it's still beneficial to be buying investments periodically over time, I would manage the emotional risk and say, well, instead of investing all of this right now, I'd spread it out over time. The second reason is pertaining to right now. Today, as I'm filming this, the stock market is, from a forward PE standpoint, second highest level ever. Oh, but wait, those earnings are at record levels. So if you normalize earnings, we are at the highest PE ratio ever. And how do I know that? Because we are by far and away at the highest price to sales, price to revenue, not to earnings, price to revenue ever, which is another way of saying we're at the highest level ever of price to GDP. There's no way you can argue this. This is expensive. And is it justified? Sure. But will it remain justified in the future, or will circumstances change? And to me, you just don't know. Much of that justification is the accommodative policy that the Fed has ushered in. And over the next 18 months, is that policy likely to change? Yeah, they've admitted to that. Will they do it? Will they be able to carry out exactly what they've said they'll do over the next 18, 24 months? I don't know. If there's any mix-up, if there's China regulations that are causing things to go haywire or whatever, I don't know. To me, I'd manage my emotions up front and do dollar cost averaging. And second, with the market being at, I would call speculative high levels, dollar cost average for sure. Is that the right thing for you? I don't know. Hopefully this perspective is helpful, but the real answer comes within the context of all 6 areas of your financial life. It just does. I could, in your situation, recommend it's better to lump sum this, put it all in based on your circumstances. Or, no, dollar cost average, and here's why. I still like dollar cost average, but it's based on your unique financial situation, what is best. So work with your CFP on that. If you don't have a CFP that's on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K, wisemoneyshow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.